We especially appreciate the people who show up for the first session on Wednesday morning on the last day of the show.
Amen.
The true warriors, as we used to say, you can go out with the boys, but you got to get up with the men. And and here we are. So thank you to all of our sponsors here at the event. Thank you to all of our attendees. Thank you to the hotel. Thank you to the elevator techs. We appreciate you. And
yes.
And we really appreciate everyone who came, who bought a badge, and has taken part in the event. We really do. Here at the educational sessions, we appreciate even more Pacific Media Technologies, the education sponsor. Actually, for the last two shows, they were our sponsor in San Diego in the fall as well. So we have Max Van Heel, Vice President of Sales and Marketing, to say a couple words.
Max.
Thank you, Thomas. As Tom mentioned, I am the VP of Sales and Marketing at Pacific Media Technologies, and we are proud to be the sponsors here at the show for PDMI, and as Tom said, this is our second year, and we are also founding members of PDMI, and as such, we're very happy to support PDMI and all their endeavors. A little bit about Pacific Media Technologies. For over 26 years, Pacific Media Technologies has been recognized as a leader in the DRTV industry. Since 1986, we've maintained our reputation by providing great customer service, speed of delivery of our advertising content to the TV stations for airing. I'd also like to, again, thank all the council members that participate in these panels and the volunteers that aren't on the councils, also for your volunteer of your time to the show. Also like to finally say, that it's Wednesday, and as Tom said, it's been a long week, and these are the last sessions of the show, and we hope that you enjoy the sessions today. And as we say in our industry, but wait, there's more. A short message from PMT.
We trust PMT because we know they're professionals. We've been working with PMT for over 20 years.
They're the most customer friendly, they're the most timely, the most accurate.
They are really wonderful with their technology and the advancements of their technologies that they implement.
They treat us like we're the only client that they have.
Whatever we need, we know it's going to get done. So that's really important to us, that personal connection.
Pacific Media Technologies. Technology driven, quality guaranteed.
All right. So again, thank you to PMT. Thanks, Max, for the kind words.
Thank you, Max.
And now we move into the actual meat of the discussion. Chris Reinmuth from FlexPay is going to host this great group. Meng Williams from Bold.com, Steve Arentzoff from FlexPay as well, and Irene Scharmack of QuickBox Fulfillment. Please take it away, guys.
Did my intros, man. No, I'm kidding. Well, thanks, everybody, and thanks, Max. My name is Chris Reinmuth. I'm the EVP and partner at FlexPay. Today we are talking about turning a transaction into a customer. And so, again, I want to thank you guys for coming up and being here this early. I know it's day 3 of the show, so I know you guys probably went to bed at 10 o'clock last night. But in terms of turning the transaction into consumer, we all know how difficult it is to obtain customers today. But what do we do with these customers once we have them? That is how important it is, the customer experience from the purchase. We want to talk about how to not just drive customers, but how we can maintain these customers and how specific programs can build healthier lifetime values. With me today, as Tom mentioned, we've got Meng Williams, the Senior Director of Finance with Bold.com. Bold is the leading online subscription B2C company providing tools and services to finding their dream job. From resume to interviews, they provide the full spectrum of services. Steve Arentzoff, SVP of Marketing with FlexPay. FlexPay is a veteran fintech company that is focused on one of the biggest problems in payments today, and that is solving failed payments. And then Irene Scharmack, the CEO of QuickBox, one of the leading 3PLs with 4 locations around the US, shipping upwards of 500,000 shipments a month. So welcome and thank you for joining us today, guys. Steve, I'm going to start with you. Topics. Discuss some of the hallmarks of creating an initial customer experience that tends to translate to longer relationships, and really focus on how important the long-term relationship is on the LTV.
Yeah, let's start with why we care about relationships. Why do we care about trying to extend an initial purchase into a customer who continues to come back to you and buy from you? Data shows that acquiring a customer takes about 6 to 7 times more dollars than retaining an existing customer. There was a Harvard Business School study that tracked companies and found that a 5% increase in retention translated directly into a profit gain of about 45–90%. It ranges across the companies that were surveyed. So what that really means is that revenue coming from existing customers is just much more profitable than revenue from newly acquired customers. We all face this, right? We all know that it's getting harder to acquire customers, media is getting more expensive, and so those companies that solve this and are able to create ongoing relationships with customers that come back to you, whether your business is selling individual products through e-commerce or you've built out a recurring subscription business model, those companies that solve that are just inherently more profitable. So the question becomes, how do you then take that ideal of trying to say, we acquired a customer, how can we get them to interact with us, and deliver an experience that then starts to connect with them? So I think when we start off in this conversation, it's really important to look at if your business model is focused around single purchase transactions, your entire model, your optimization, all the metrics you track are focused around how you optimize the ROI of an acquisition. And shifting that focus to start to look at, after I acquire the customer, what happens to that? And building that experience that is might go above and beyond, where you start to create new metrics to track what are the factors that lead to healthy relationships, that lead to more customer delight, is the right outlook. And so we'll get into that. I know a lot. I know that our panel has a lot to offer on this topic, but I think the most important aspect when you start to focus around what it takes to create a relationship is to look at the initial transaction, initial interaction you have with the customer as the opportunity to create a healthy, lasting relationship. And so everything you can do to deliver that, to engage with the customer, to over-deliver on their expectations, helps set up that experience and creates that opportunity.
Well, let's dive into that a little bit. You talk about a successful campaign ROI is typically measured transactionally, right? Meaning that a successful campaign is measured by revenue earned and subtracting the cost of customer acquisition. This is media cost, fulfillment cost. Steve, why don't you talk a little bit about that, give some opinions on how important it is creating those healthy relationships. And then Meng, I think I want to hear from you and how you guys measure that at Bold.
Yeah. If you look at companies based on their business model, the metrics they use to track success looks fairly different, right? So if you're focused around a single transaction, you are going to work to optimize your media buys. You're going to try to get that as efficiently as possible. The ROI measurement you're looking at is, I purchased media, I have my fulfillment cost, I drive some revenue out of that. What's the ROI in that transaction? And if it's positive, you're happy and you go on, you try to optimize that and repeat it. If you're looking to acquire customers that continue to transact with you, then the way you design the experience, it starts to become a little bit more broad. For example, the purchase experience, whether your customers are transacting with you online or with a live call rep, trying to build out a healthier experience, trying to understand what that looks like. I think there are a huge suite of metrics that you can gather to measure customer satisfaction, to make sure that the customer is purchasing what they thought they were going to buy, to be able to follow up afterward and understand whether or not they're satisfied with the product that they got. I can talk about the fulfillment experience as well. That and starting to look at that over not just the initial transaction, but also start to design interactions that you can create with that customer afterward. Follow up, were they happy? Start to understand their satisfaction levels, because I think probably the easiest metric to track that correlates with the probability of a follow-up purchase is satisfaction, both on the experience, what the customer expected, and the product satisfaction as well.
Meng, comment on that?
Yeah, for sure. So I think as a finance person, looking at ROI is very important. But I see a lot of people making mistakes when they calculate the I and the R. Thinking about investment, a couple of common mistakes I see. One is really understanding what is your cost per acquisition. A lot of people, they look at, they don't really track the whole funnel, right? Like how your customer engage with your marketing channels. A lot of businesses have online channels and offline channels, and you could be paying for the same customer twice and 3 times. I mean, you may not even know. I know multi-channel attribution is a very hard topic, but you need to try to understand your touch point. So you try to understand your true cost per acquisition instead of just a blended one. And another thing kind of Steve mentioned earlier is the cost to retain a customer, to gain a customer for repeating purchases is much lower than the new customer. And another mistake I see is companies kind of use this blended cost per acquisition, but you really want to separate your new customer acquisition and return customer acquisition cost, and you want to understand how you are reaching out to your old customers, and you want to use more like the lower cost channels to bring down the overall blended cost. On the return side, I think the mistake people make is look at the first transaction, as you say, and once you have the customer, you want to engage with them on cross-sell, upsell. If they want to cancel, this is your time to make a safe offer and really reinforce the value. And if they leave, you can try to win them back. You want to calculate all those, incorporate all of those follow-on transactions into your return calculation. And something from like the data we have seen, the first 30 to 60 days is very important. Once you get the engagement and the satisfaction past the first 30, 60 days, the retention is very, very high. You're looking at like 80, 90% retention rate, and the customer really stay with you. That will bring you that stability into your cash flow forecast.
That's great. Yeah, and also just to add on to that, I think that the key change we're talking about is changing your ROI perspective from a transactional ROI to a customer ROI, right? If you look at your media channels, I can guarantee there's going to be different ROIs at the customer level across media channels. Customers coming from search are going to be very different from perhaps DRTV. And so once you start to develop the suite of metrics that allows you to unlock visibility to what acquisition sources and what experiences you're delivering that translate to longer relationships, then starts to give you the language and the tools to be able to use to manage it.
Yeah, that's great. Irene, do you want to comment on that? Because I know QuickBox very well, and I know you guys are shipping 50 to 60,000 orders a day and working with some really big customers. I mean, talk a little bit about, do you guys look at ROI with your customers? I mean, do they measure that as much? And I'm sure they do, but I mean, how in the weeds do you guys get with your customers on that?
Yeah, so one of the things, I was just at a conference, and one of the big topics was post-purchase experience, right? And so for us, I think it's really understanding, we're not dealing with the end brand. I mean, they're consumers. We're dealing with the brand themselves. So one of the things that we implemented is we implemented our client services survey. We launched it to all of our clients so that we could understand what are their consumers saying and how do we actually improve our business. The way that we actually measure success is we have key performance indicators related to on-time ship, what is the returns ratio, what's the accuracy of the orders that are going out. So that's really how we're measuring success. At the end of the day, the post-purchase experience, if everybody's working so hard to acquire a client and we don't execute, right, that client then is not a repeatable client. So, so we measure it.
Yeah, that's absolutely true. Let's talk about long-term relationships. Why do long-term relationships lead to such strong business results? Talking revenue and profitability. Meng, let's start with you. Dive into the high cost of customer acquisition. You talked a little bit about that in attribution and understanding that. Can you talk a little bit about the importance of that?
Yeah, the cost of acquisition, like for us, we're online, so most of our channels are the Google SEM and SEO, and definitely we have seen the past couple of years, Google, of course, they want to optimize for their own revenue. We have seen our cost per acquisition has been fairly steady, but our cost per clicks has increased double, triple in a couple of years. It was very scary. So you need to stay on top of that. You need to be aware, even though your CPA might be flat, you really need to know your competition is getting more and more. And they just rolled out a couple of changes lately that really made that cost even higher. So really it's important for the business to kind of keep up with it by increasing your lifetime value of the customer to maintain the healthy margin. And from a finance perspective, this is especially important to me because during the first couple months of COVID, our demand took a big hit, which was most of the business. But like the way I see our revenue is I see it in layers. My bottom layer, the bulk of our revenue come from long-term recurring revenue, and that's very stable, very visible to me. And then I have a medium layer of kind of the newer users and the top layer of brand new users. So during COVID, because we had that bulk of recurring transaction and revenue, we had no issue with the cash flow. We continue to operate, didn't have any layoff. pay dividend to the shareholders the entire time because you have that layer of the recurring user revenue that kind of help us weather through
That's really interesting.
the up and down of the economy.
Yeah, I mean, do any of you guys want to comment on that? Because we've talked about, during the COVID years and how we survived, but, how those customers and that revenue actually helped a lot of companies.
And I think it's, clearly during pandemic when consumers didn't have access to products and services they needed, they jumped on and increased their demand for subscription services. We saw that it exploded. That growth has certainly slowed in the past year. But I think it's also important to recognize that even before pandemic, traditional businesses were embracing the recurring billing model because they recognized how successful this could be from a profit perspective. They recognized the high cost of acquisition and tried to, from traditional brands and across the categories, everybody tried to create a subscription model because of the profitability that was inherent within it. So I think that really speaks to the idea that the reason that it's attractive to go down that path as a business, and the way you start to manage it is all tied around retention and relationships. The longer you can keep a customer, simply the more profit you can earn. Again, it comes out of that dynamic that customer revenue is much more profitable when it's coming from a customer who's been with you for a number of billing cycles. And if you recouped your cost of acquisition, think about what your margin looks like if you're not having to pay that media cost after 5 or 6 payments, and they now are turning out 80% profit.
And what we do at QuickBox is we have like a cadence for communication with our clients. So we're in constant communication with them. Every week we have client services on there so that we understand we're an extension of their brand so that they continue to get repeat business. And then we have like quarterly QBRs where we talk about like what is their brand doing, what are their consumers saying, and then how, for us on the back end, the post-purchase experience, how do we improve that? So.
Yeah, that's important. Steve, let's talk about, we're introducing the idea that a long-term relationship versus a single purchase customer is a higher level objective and one that leads to healthier business results. Talk about what are the key parts of the experience that should be delivered here?
Yeah, I think that, my role in B2B marketing is obviously different, but there's a lot of analogs between B2B marketing and what we're talking about on relationships. Because the sales cycle is long, we have to create an experience that engages with our customer, gives them the information they're looking for, gives them a sales experience that's very positive, and then creates a customer experience that drives retention. We follow the same objectives around retention for the same reasons. And so we look at how we design the experiences, trying to understand the customer's need. I think it's really instructive. We all run different campaigns, right? We run different messaging. We have segmentation about how we can attract a customer with a different angle, a different story. We use different media channels, and recognizing that and starting to not just use that to acquire the customer, but retain that insight and drive individualized experiences, again, your segments post-acquisition. I think as Meng said, when you think about a relationship, recognize that the purchase transaction is the first chance to create a great impression. Right? So if you're driving a sales experience that is not high pressure, but is listening to the customer, making sure they're getting access to what they want, delivering what they expect, maybe creating some delight when they interact with their actual product, service, or brand, you're off to a good start. Creating a follow-up experience, hearing from them. Customer satisfaction surveys are a great, easy way to be able to gather feedback. Typically, the customers that respond to a survey are either very pleased or very unhappy.
This is true.
So you'll get some bias in that. You have to interpret in the right way, but it also gives you very important signals. And certainly, if customers respond to that, often the customers that aren't happy, that have a great recovery on their customer service, actually turn out to be your best customers because you've been able to resolve their issue and make them happy. So use those interactions, have every opportunity that you can create for your customers to reach out and connect with you, because if they're talking to you, then they're going to be active.
That's great. You want to comment, Meng?
Yeah, I want to add to kind of the perspective from B2C online business, because we don't have that human interaction, don't have the opportunities to really wow your customers, so everything's online, self-serve. I think one key thing for us is to really build the trust online with everything's digital. And because if you want to build that long-term relationship, you need your customer to feel comfortable giving them your credit card and have that store on file. Because they don't, if every time they have to take off the card, it's a lot harder. The key is that building that trust. It's interesting, like we see that like the look and feel of the website is very important. just because your website is not breaking, you still want to update the newest look and feel. People have this tendency to think if the website looks old, it's probably not secure.
Yeah.
You want that secure logo on your checkout page, especially the credit card page is super important. You want to make sure that they feel safe when they give you their credit card, essentially. And then you should make them like safe and secure, not just a look.
Well, and I love that you spoke about trust. That's something that we talk about at QuickBox all the time, right? I mean, that's like the foundation for building relationships. And you know, if you think about your experience when you buy something and you hit the click button, everything else is kind of taken for granted, right? How quick did it get there? How inexpensive was the shipping? How was it packaged? What collateral was inside? If you have to do a return, how easy was the return? So all of that plays into like building trust. And when it all goes right, you're not necessarily going to hear about it, right? But when it goes wrong, you're definitely going to hear about it. And that's one of the reasons why we work in really hand in hand with our clients to understand what are their consumers saying.
I think that's a great point, Irene, that even thinking about what the fulfillment experience looks like has a huge impact on the customer's perception about your brand and the quality of what you're delivering. If your focus is just minimizing the cost of delivery, whether it's the postal level, or how long it takes to get there, what they see when they open, that's their first interaction. And if it's a virtual relationship you have with your customer, it's the only interaction they're going to have directly with you. So being able to create an experience that you design that you can, and those are very easy things to test, right? We test in media all the time. Test the different experiences to see which ones correlate with customers coming back to you because they're happy.
Yeah, that's great. Well, you guys leading into my next question. I think this is really for all you guys. Irene, I'm going to start with you. This is like the post-purchase experience. Delivery, unboxing, payments, returns. What are some of the ideas to create customer delight? I know some of your customers specifically, you know, I think of somebody like Skinny Fit. They're very, very protective of the brand. You know, the boxes have to be specific, and they were one of the first customers that I knew of, 4 or 5 years ago that was really operating that way. So maybe talk a little bit about that.
Yeah, I think for us, we really enjoy getting in kind of at the ground level with owner founders. That's really kind of a niche of QuickBox. And I would have to say that the reason for that is that a lot of times when a brand like Skinny Fit is coming to market, they only know what they know in the fulfillment space. So what does it look like related to shipping to the consumer? What should the branding look like? Actually, what's the package size that it should be so that you can minimize postage costs? So really understanding that and then working hand in hand with them in a consultative manner to then bring them to the table and say, here's what we've seen in the industry for best practices. Some of our brands started with us at 800 orders a day, and today they're doing 20,000 orders a day. It's an awesome story, right? And to be able to be part of that experience and working hand in hand with the brands, like I said, it really starts with trust and then really being connected and not being totally separated from the fact that this is just a transaction. And the way that we accomplish that internally is that we have a very high level of communication for everybody in the company. So that's not just for me and the folks who report directly to me, but we have a cadence of communication so that the folks, every salaried person, every week is on a call so they know what our clients are saying and how do we improve on that. And then those folks then take it to startup meetings on the floor. So somebody actually packaging the box really feels connected to the brand to say, I'm part of this experience that it goes to an end consumer.
Yeah. Oh, that's great. Meng, do you want to comment on that at all? I mean, you're the post-purchase experience.
Yeah, for sure. As I mentioned earlier, the first 30 to 60 days is crucial. So once the customer made the first purchase, that's your opportunity to engage with them and to show the other things you have to offer, right? Because we're a subscription business. People kind of come in with a resume. Now we have all the other services we can provide. And so what we say here is trying to reduce the cognitive load for the customer. So once they're done, like we want to just show them all the things they can do, but normally they just get lost and they don't do anything. So we want to give them one option, what we think is the best for the customer, and just think of kind of how Netflix, once you watch one movie, they don't take you back to the homepage. They show you what to watch next. That's kind of what we find out to work very well for us. Just give them one last thing to do, and they will most likely do it. And then we'll keep engaging with you and stay longer and more engaged.
That's great.
And I want to comment on something Irene said that I think might have gotten missed. What she referred to is actually having somebody own this. And I think that's incredibly important, that you actually create and design an org structure where somebody owns customer experience, somebody owns customer relationships, so it becomes a full-time focus. And there's very easy ways to approach this, right? I think that changing the mindset from, okay, I have a customer now and I'm just going to start slamming them with emails to buy something else is not what we're talking about, right? So if we think about what Meng said, think about the first 30 days as a way to anchor the relationship. And there's easy ways to create content, recommendations on getting the best uses of your product, having other ways that customers are finding, maybe creative ways to take advantage of it. Use that as a way to start to anchor, get the cadence delivered where your customers expect that when you communicate with them, you're going to be talking about something they care about. They're going to be opening the communication setting, whether it's email or different formats, and it starts to train them that they want to interact with you, which is a very different mindset.
I think one of the mistakes that my competition is making is there's a lot of competitors that are out there that have moved to ticket systems and help desks. Like it's all automated, so you're not actually connecting to somebody who cares about your brand. Right, so we've doubled down on our client services team. Like I said, they have a cadence for communication with the clients, so they're truly an extension of their brand, and our clients feel represented. So imagine, for us it's competitive advantage, but imagine you're dealing with a fulfillment house. This is your brand, you worked hard to acquire that client, and now you have a massive failure because orders aren't shipping or they're wrong. I mean, and then you have nobody to get a hold of, right? So that's something that we've lost a little bit as I think as an industry in 3PL is taking that client piece away.
Right, that's really changed the perspective from how do I minimize costs to how to maximize profits and revenue, and it makes a difference.
Yes, it does.
Well, let's talk about that. That kind of leads into metrics and how to manage it and measure it. Steve, you just recently conducted a study on this. You want to talk a little bit about that?
Yeah, FlexPay, in conjunction with a company called Payments, conducted a benchmark study of a couple hundred companies in recurring billing. And we really want to understand what were the best practices that correlated with high levels of financial performance. And one of the key learnings we saw was that everybody's familiar with the term lifetime value, LTV. So LTV, if you're not familiar with it, is a way to calculate the costs that you have to incur on acquiring a customer and then servicing them with the revenue. And the best practice is to be able to calculate this literally for every customer. It becomes an ongoing metric that you measure as customers are retained longer. It gives you a very powerful tool to be able to go back and look at your sources of acquisition, different experiments you're running to see which ones correlate with lifetime value. And what you'll find in that equation, just a spoiler alert, is that the single biggest lever that drives profitability is retention. Not surprising, it's the biggest, it drives revenue, your customer acquisition costs are fixed, so the longer the customer is retained, as soon as the customer acquisition costs are recouped, then you're dropping enormous amounts of profit to your bottom line. So what we found was that if the companies that tracked LTV were 9 times more likely to be top performers than those that don't. And I think there's a lot of hidden nuggets in that insight. For example, when you think about this, what we're saying is not just that there's measurement of LTV, but there's actually management by LTV, right? There are people within the company whose job it is to be able to understand the metrics and be able to drive the initiatives that are aimed at improving the LTV. And so it really spans across the organization when you think about, okay, we want to create the metrics, we want to make sure that there's distributed widely across the organization. We understand what initiatives are being implemented to try to improve that, and then people are being held accountable to the results. And so there's so much power that comes out of that equation that's under the covers there, that's a little bit under the old iceberg metaphor. You have the LTV metric on the top, there's so much underneath that's richness that you can start to take advantage of. And what was so exciting for us is when we started to look at this and got confirmation. It's the first time I've seen this kind of broad confirmation that the companies that really get this are just seeing outsized returns in comparison to their competition.
Meng, do you want to comment a little bit on that?
Sure, I think I completely agree with what you said. I think just dive a little deeper. I also manage our M&A activities at Bold. So I see a lot of smaller companies, they track LTV, but it's very incorrect. And mostly they will underestimate their LTV. 2 mistakes they make. For one, they tend to just, you ask them what's your LTV, they pull their data from past 2 years, how much people have spent on average. So that's definitely underestimating.
They don't know how to measure it.
Yeah, they don't. And the other thing they do is they Google a formula and then apply it. It's probably wrong. Yeah, the thing is, if you take historical view, for one, like you are not thinking perpetuity, right? Because as I said, once they pass the first couple of months, the 80-90% likely to stay with you. And you want to capture that portion that could be easily 10-20% of the LTV you are missing. The other piece of the LTV is if you don't calculate correctly, then you end up underspending our cost per acquisition. You're missing market share, which a lot of companies do. When we buy them, we get the updated LTV, we bid on more in the auction, we essentially get a lot more market share. Yeah, that's very easy to change, and people just don't calculate correctly. And the other thing I want to talk about is kind of Steve mentioned as well. You want to look at different segments of your LTV. You don't want to just have one number, especially if you're a global company. You are, like, for example, our India LTV is significantly different from US LTV, from LATAM LTV.
Absolutely.
Yeah, your different acquisition channels, different segment of cohort, different experience level of your customer, they all have very different LTV. You want to really optimize your LTV per segment so you can really get the most market share for the segment that you want to go after, and don't overspend on the ones with the lower LTV.
Yeah, and I think what Meng and I are both saying is that we're not talking about just measuring it, we're talking about operationalizing it. We're talking about creating the mechanisms of your systems to be able to track it at each individual customer level, and then making use of that across the organization and giving the access to people. In fact, I'm so passionate about this. If anybody's interested, I'm happy to connect afterward. We've got content around it, and I'm happy to follow up with you and give you both some guidance on how to calculate LTV and some suggestions about how to apply within your business.
I think the industries really shift. I think a lot of people, I mean, I've been in this space for 25 years, and it used to be there really wasn't much. There's 2 companies that really focused on retention. And I think, you know, obviously with the adoption of online, I see people like Michael Weinstein out here that have taken companies online. Small plug for you, Michael. Not that you need it. But all kidding aside, I mean, the companies are really focused on, you know, the LTV and really looking at it. It's harder to get that customer today, and once we have that customer, what are we doing with it? So. The last question I have is kind of, you know, one of my favorite is talking about retention and churn. You know, I think we have a good experience, amazing experience with Bold, and hopefully you feel the same way. Talk a little bit about the retention and churn and some of the efforts that you've seen and how that has actually led right into, you know, customer experience.
Yeah, kind of just one step back a little bit, like the way we measure, kind of, we really at Bold are very data driven. We look at everything by data, and data tell us what to do. So the way we kind of see our churn is we build this report we monitor monthly. We call it retention rate decomposition report. So most people just think, a lot of companies think this retention, then there's churn. But there's a lot more different nuances in that churn. There's volunteer churn, when customers go actively cancel their subscription. In that case, the customer is in front of you online or with a customer service agent, and you want to take advantage of that opportunity to reinforce the value, trying to retain the customer. But the other side is actually a pretty big chunk of the churn is involuntary churn, which is caused by failure of payments. It's actually a lot bigger than a lot of companies think, and it's at Bold, we're able to recover north of 50% of that involuntary churn through the 30-day post that first attempt failure. And there are a couple of ways to handle that involuntary churn. First of all, you want to optimize your payment structure. You want to make sure you minimize that, right? Like, there are a lot of companies out there. There are a lot of strategies around how to optimize the first attempt success rate. But once that passes, you want to look at your decline reasons. There are a lot of, if you look at your payment data, they tell you a lot of story. They tell you if the transaction failed because they don't have money in the account, or because the bank suspect is fraud, or because the maybe just they will just not tell this is a general decline. So you need to manage the retry attempt. You want to reattempt those transactions at different time and different strategy based on the decline reason. So if you have a big team and you have the great infrastructure for billing and you have the bandwidth to manage that, you can definitely do that in-house. Or if you want to free up the bandwidth of your team, and you can outsource that for companies like FlexPay. And so Bold have been working with FlexPay for a year and a half now. We're very happy with the result. We free up my team's bandwidth looking at other data, and we have a FlexPay taking care of our retry logic. Yeah.
Great. Steve, you want to comment on that at all?
Yeah, and I think when we talk about relationships and retention, really focusing on all aspects of the life cycle of the customer, and trying to plan out how you manage it and try to maximize that. So again, there's the direct response industry and the performance marketing industry has so much of a legacy and a history of optimizing acquisition and using metrics and creating testing and simply expanding that out to a life cycle of a customer, using the same techniques, the same tactics is a wonderful way to start taking your core competencies and using it in a way that will actually drive better business results. So when we talk about the customer life cycle, I think, and Meng, I'd love to talk a little bit about what Bold does, because we were talking yesterday and actually crafting out what the experience is going to be for the first 30 days, actually creating an experience that anchors a relationship, I think is exactly what we're talking about. And then recognizing over time, as you start to look at this, what are the signals that you're getting where a customer's happy or signals that a customer might be at risk, and starting to interact and starting to intersect customers that might be at risk for churning. I'll tell you a happy experience I have. I'm a Peloton customer. I don't know if anybody else rides the Peloton. Last year, they had a fun, neat experience for me. And I talk a lot about customer delight, right? The idea that if I'm a customer of a company and they do something unexpected, it delights me. I'm really happy to talk about it. I share it with my friends. In this case, they had an annual contest where they tracked how many minutes over the year you exercised. And I decided I want to go reach 18,000 minutes for the end of the year, and I pushed for it in December and got over it. And then a month later, I wasn't just get the little social badge on my app, but they actually sent me some swag, some clothes in the mail. It was totally unexpected.
Yeah.
And I think that's a great example of when your most valuable customers, the most engaged customers, the ones you really want to retain, because not only are they going to continue to purchase from you, they're probably talking positively about you and recommending you to other people. Those are the customers you want to focus on, because if you can delight them, you get a lot of value out of it.
Yeah, actually, you remind me of something. We kind of tested something recently. We're seeing very positive result from data. I feel like this is a kind of a newer trend during the COVID, working from home, is webinar. We've been trying to host webinars for our customers. And the key here, I think, is to not make it very high pressure sales pitch on the webinars. Really understand your customers' need and make it really about them and solving their problems and really provide value to the customers. So I know there's correlation and causation. It doesn't necessarily mean this is the cost for the increase in LTV, but from the early data, we're seeing north of like 30 to 50% of increase in retention and engagement for the customers that do register for webinar compared to the ones they don't. Again, not necessarily causation, but they definitely really appreciate the value. It's also a way to remind them about your brand, so they can come back. Oh yes, I know there's something. I subscribe. Let me take a look and get more value. That's really a great way to engage.
That's great. Irene, you want to have a final word on churn at all?
I think for us, it's because we're not dealing with the end consumer directly, right? We're dealing with a brand, and getting that feedback from the brand on how well we're servicing their consumers is important. For us to implement a client and to onboard them, there's a huge investment, right? So it's not just, there's IT, there's capital infrastructure, there's the onboarding, and so you have all this massive lift of training and ramp to just bring on a client and do it successfully and not impact their brand. So the last thing we want, is to onboard a client that has, a massive investment. Let's just call it a 3-month lift with. We just onboarded a client. We invested $1 million of capital. And so the last thing we want is to churn that client, right? So I'm I don't know if it's a positive leadership trait or a negative one, but I'm very paranoid.
Yeah.
So every time I hear little rumblings of something, or there's something not right on a call, and the team knows this too, we want to get on front of it. We want to be very connected to the brand. We want to understand what they're saying behind closed doors. That's super important to me, right? Because it allows us, I can plan for anything, and if I know what my brand needs, then we can service them accordingly. So, we've had some churn that has been intentional, and the reason for that is we wanted to center our focus on our ideal client profile.
So important, and I know we have mutual customers, and you and I talk, and you'll call me about a customer and, that maybe from an industry that you're not aware of, and we'll look at the, are there FTC complaints, are there customer churn? Being in the processing space, you can understand what are their chargebacks,
Yes.
have they been put on match, and those are really important things to have with vendors,
Yes.
because if they're not taking care of the customer, or they have bad B2B ratings, or BBB ratings, those are customers you really don't want to onboard.
That's right.
And one data point I want to also share with, I thought was fascinating, going back to our study, one of the dimensions we uncovered was that the correlation performance was not tied to the size of the business. It was tied to the percentage of the revenue that came from recurring billing, which made sense, right? So we saw, for example, billion-dollar recurring businesses that were part of a $10 billion organization that were much farther behind companies that were only a $50 million business, but 100% of the revenue came from recurring. And so my suggestion to you is, if you're already in recurring, do the things that really matter. Do the things that drive retention, because it'll drive so much more profitability for your business. If this is new to you, don't wait. If you're transitioning from a standard transaction to recurring billing model, start to take these advances now and focus that as you build out that business, because it will build such a stronger foundation for you, and the profitability will drive will accelerate your growth. You have so much more profit, you can invest more in customer acquisition, you can invest more in the customer experience, and it really gives you a leg up on your competition.
That's great. Well, I want to leave time because I know all of these people have tons of questions, and I know we're butting up against about 45 minutes. I want to thank our panelists today, so Meng, Steve, and Irene, thank you. You guys make it very easy for me to moderate, and I want to thank the PDMI team, absolutely, for the opportunity. So very much thank you.
Thank you, guys. Questions, as Chris noted. I think we got one right here.
How you doing? Michael Weinstein with Gem Direct. Thank you, guys. This was great, by the way. Took a bunch of notes.
Thank you.
So when it comes to customer retention, lifetime value, and things like that, obviously part of that involves keeping customers that might be looking to leave at a certain point, a save the sale, a rebuttal, something like that. Are you seeing any changes where this doesn't have to be exclusively discount focused, where you're just giving somebody money off to stay with you, and perhaps instead offering additional values or reminding them what they might be losing if they don't stay with you? What kind of things are you seeing, and what success are you having in keeping a customer looking to potentially leave?
Yeah, I can start. So we do have a career advice service, right? We have a big package. A lot of times customers come in, they have only one single problem they want to solve, so they're not using the other services. Most of our customers cancel online, so what we do is definitely, we just say, have you used this service yet? It's worth X amount of dollars. And we actually find a pretty good success rate for just saying that. A lot of times, because they're so single-minded the first time they use a product, so they actually don't realize there are other things that can be done. And just giving that reminder seemed to work really well for us. Yeah.
Yeah, I think there's also there's two elements to that question that are important to unpack. The first one is, can you start to predict which customers are more at risk of churn? And if you're an online business, it's fairly easy. Look at interaction, look at usage, look at logins. There's going to be a direct correlation with your customers who are not using the service, they're not getting value out of it, and the probability of churn, it will be higher. I almost guarantee it. Now, if your business is more direct with physical product, there's still probably other ways you can look at that. As you're continuing to communicate with your customers, if they're starting to ignore you, not opening your emails, that's probably an indication they're less engaged. So look for those things and then start to interact. I think in a general way, though, discounting price is probably your last fallback in tactics to try to save a customer. Look at adding value. Look at finding ways to be able to give them access to a service for a time being, or give them education or advice on how to use your product or service. That's typically much more effective and anchors the relationship for usage anyhow. And probably, again, as we talk about how you create an experience initially that will drive longer retention, start with those. As soon as the customer comes on board, make sure you're giving them that kind of experience so they start to become more connected to your brand, and also they get it's self-serving, right? If they're using you more directly and more deeply, then they're typically going to last longer.
I also think that, like if we have a client that's transitioning from one fulfillment house to another, I think just, that during those transitions, there's going to be challenges, and this is just a way to prevent churn. is to be really forthright in your communication with those clients in advance, to let them know, hey, we're making a change, we're moving to a new fulfillment house, there may be a delay in shipping. And they had product in 2 locations at one time, and there was a delay in shipping, and the last thing you want to do is lose a client because they were expecting their product 2 days ago, right? And now they've created a lot of noise, unnecessary noise. Had they gotten on front of it and sent an email in advance, it would have been expected. So.
Any other questions? I mean, they were good, but were they this good? Anyone else? All right.
We answered all their questions.
That's all.
So.
You nailed it.
Yeah.
Thank you to this great group.
Yeah.
Let's have a round of applause for
Thanks
them.
for having us.